financial crisis in the next 3 months, 90 days. That is the window, the countdown, the final chapter of a game that has been played for decades. People hear the dollar is weakening and think that's the crisis. It isn't. The falling dollar is only the opening scene. The real blow, the moment that can rewrite the global financial map, is scheduled to be triggered in roughly 3 months. And for millions of people who think this has nothing to do with them, that moment could silently erase everything they've worked for. Yet for a small group who understand what is coming and hold the right kinds of refuge assets, that same moment could become the opportunity of a lifetime to cash out near the top and buy the world at a discount. So what is actually happening? Welcome to this episode of Money Mindset. Let me put it this way. You can forget your girlfriend's birthday. You can miss your wedding anniversary and, at worst, pay the price with a few luxury handbags. But there is one date this year you cannot afford to forget. If you ignore it, years of savings, the wealth you quietly built through overtime, side hustles, and sacrifices can be wiped out in a single financial storm. That date is the last day of June this year. Why? Because on that day, a colossal debt, about 6.5 trillion US dollars, that the US government borrowed in previous years comes due. That is not a typo. Trillions. And on that day, the world will see how America intends to deal with this bill. You might think, if the US doesn't pay, what does that have to do with me? I live halfway across the world. Why should I care? That reaction is exactly why so many people get blindsided in every crisis. Most still don't realize how serious this is. The $6.5 trillion in question was mostly borrowed during the pandemic years. Back then, the global economy was collapsing, markets were being halted, and panic ruled the news flow. To prevent a full-scale depression, the Federal Reserve, America's central bank, started rapidly expanding its balance sheet. In simple terms, it printed money and pumped it into the system. Then, that freshly created money was used to buy government bonds and to lend to Washington and to Wall Street at near zero interest rates. That means a huge slice of the $6.5 trillion that comes due in June was borrowed at almost 0% interest. The US could splurge without worrying about interest costs. To prevent a full-scale depression, the Federal Reserve, America's central bank, started rapidly expanding its balance sheet. In simple terms, it printed money and pumped it into the system. But here is the problem. So what must it do? It has to borrow new money to repay old money. There's a term for that: rolling over debt. In practice, it means retire the old, cheap debt. Replace it with new, expensive debt. Because in the last few years, the Fed has been hiking interest rates aggressively. Today, the US government has to borrow at around 4.5% per year instead of nearly 0%. Let's humanize this with an example. Imagine I lent you $1 million 5 years ago. I told you, don't worry about interest. As long as you give me my $1 million back in June this year, I won't charge you any extra. You'd be thrilled. For 5 years, you can use that million however you want without any interest pressure. But by the time June arrives, you've spent it all. You don't have my 1 million anymore. What do? You borrow 1 million from someone else, then use that to repay me. Now you owe the new lender. Except this new lender demands 4.5% interest per year. So over the next 5 years, you won't just return 1 million. You'll have to pay over $200,000 in interest on top of the principal. That is exactly what is happening with US Treasuries. During the pandemic, the US government borrowed huge sums at extremely low interest. They spent freely because the cost of debt looked painless. Now, with only a few $100 billion left in the Treasury and $6.5 trillion coming due, they face a hard reality. They must either repay the debt, which they cannot with current cash, roll it over, borrowing at 4.5% to pay off money borrowed at nearly 0%. That means transforming cheap, harmless debt into expensive, heavy debt. And it gets worse. To roll over that debt, the US needs investors willing to lend at these higher rates. But are people still eager to buy US government bonds like before? Once upon a time, the answer was automatic. Yes, in the past. Even when Treasury yields were extremely low, investors all over the world still rushed to buy. Why? Because the price of US Treasuries kept rising. Here's how it worked. You lend $1 million to the US government. In return, you receive a bond, essentially an IOU promising repayment. That IOU can be traded in the market. In the old days, bond prices usually went up. You might buy a bond for 1 million and a few years later, sell it for 1.1 million. The yield was tiny, but the price gain was attractive and seemingly risk-free. From 2014 to early 2020, the value of many US Treasury bonds doubled. In just 6 years, your risk-free asset could double in price. Because everyone trusted that the United States, the world's superpower, would always repay its debts, Treasuries earned a sacred label, risk-free assets. If prices fell temporarily, you could just hold to maturity and get your money back from the US government. If prices rose, you could sell early and pocket a profit. To most investors, it felt like a game you couldn't lose. So what did they do? They used leverage. Suppose you had $1 million. You bought 1 million in treasuries, then took those bonds to the bank as collateral. The bank lent you $950,000. You used that to buy more treasuries, then pledged those again, borrowed another 900,000, bought more, and repeated the cycle. Layer by layer, you built a tower of debt on top of risk-free bonds. Some investors leveraged 5 to 6 times. With only 1 million in real capital, they controlled 5-6 million in treasuries. You used that to buy more treasuries, then pledged those again, borrowed another 900,000, bought more, and repeated the cycle. But in mid-2020, something changed. Bond prices started to fall, and they didn't stop. Now imagine you're the bank. A client has pledged 1 million in treasuries and borrowed 950,000 from you. If those bonds drop in price to 950,000, your cushion is gone. If they fall to 900,000, your loan is now larger than the collateral's market value. Will that client happily return 950,000 to redeem bonds now worth only 900,000? Of course not. So what do banks do? They issue margin calls. They demand more collateral or immediate repayment. Leveraged investors, trapped and desperate, begin to dump treasuries to get cash. Their forced selling pushes prices down even more. In just 3 years, this cascading liquidation erased nearly all the gains that had built up over the 6 years before. Why did treasuries fall so hard? One major factor. China and Japan, two of the biggest foreign holders of US debt, have been selling large amounts of US bonds in recent years. The narrative flipped. Before, everyone rushed to buy treasuries, prices climbed, and they felt perfectly safe. Now, prices fall. Central banks like China and Japan sell aggressively, and several US banks collapse under the weight of bond losses. If you were a global investor today, would you still eagerly lend your money to the US by buying these bonds? This is the trap the US finds itself in. Before, everyone rushed to buy treasuries, prices climbed, and they felt perfectly safe. Now, prices fall. Central banks like China and Japan sell aggressively, and several US banks collapse under the weight of bond losses. So what options remain? Think of US treasuries as a huge, old, fragile building. You can keep repainting the walls, patching the cracks, reinforcing weak beams, but the foundation is rotten. Every repair buys you time, but not safety. The other option? Every repair buys you time, but not safety. In financial terms, that means allowing the current system, the overvalued bonds, the inflated stocks, the dollar's status, to collapse, then using the chaos to reset the game and grow faster than the rest of the world. In 2008, when the housing bubble burst, the US effectively chose to let the building explode. The world entered a brutal financial crisis. And yet, after the dust settled, it was the US that recovered the fastest. Now, once again, we stand in front of a ticking device wired into the heart of the global system. The question is, will they try to keep patching this old house, or will they intentionally let it blow again? And if they do, what happens to your savings, your investments, and your future? If you lived through 2008, if you remember the sickening headlines, the panic on TV, neighbors losing homes overnight, then you already know. Financial crises do not politely knock on your door. They hit you from the blind spot, precisely when people keep saying, that has nothing to do with me. In 2020, history repeated itself in fast forward. Global markets halted trading. Entire economies were frozen. And once again, those who shrugged and said, I'm sure it'll be fine, watched their portfolios melt. But there was always another group, the ones who read the signals early, the ones who stepped aside before the avalanche, and then walked back in when the ruins were cheapest. They didn't just survive. They leapfrogged to the next level of wealth. This time, the script may be even more extreme, because now the crisis is not just about banks or housing, it's about the very structure of US debt, the dollar, and the global financial system that has been built around it for decades. For people who keep telling themselves, this is not my problem, the last day of June could become a private 2008. For those who understand the playbook, it could be a once-in-a-lifetime chance to change social classes. That's why I created this channel. Not to scare you, but to help you read the board before the move is made. If you don't want to be just another casualty of the next crisis, you need to understand one key question. What can the US government actually do? How do they solve the problem of turning cheap debt into expensive debt with almost no cash left and a world losing confidence in their bonds? There is only one realistic path that keeps the system alive. The Federal Reserve, the private, powerful central bank sitting above the US government, must step in. It must stop shrinking its balance sheet. The Federal Reserve, the private, powerful central bank sitting above the US government, must step in. Use that newly created money to buy US Treasuries. Lend cheaply to the government so Washington can keep spending. And, in an ideal scenario for Wall Street, it will also cut interest rates possibly back towards 0%. But here is the deeper question. Why would the Fed do this? Because if no one steps in to buy US debt, the government eventually faces something they've always avoided in modern times: default. Imagine this. The US government stands up and says, we can't pay back what we owe. These IOUs, these bonds you hold, they're just pieces of paper now. Every pension fund, bank, central bank, and investor holding those bonds would be left staring at a pile of glorified trash. What do you think happens next? Confidence collapses. If a country as big as the United States can casually walk away from its obligations, why would anyone on earth still trust the dollar, the currency backed by that very government? People would rush to sell their dollars, dump their US assets, and grab anything that looks safer: gold, other currencies, real estate, commodities. It would be like a bank run, but on the world's reserve currency. To understand this, think of it like your local bank. Why do you put your money there instead of under your mattress? Because you believe it's safer. But if that bank suddenly announces, we're bankrupt, you might not get your money back. You wouldn't just calmly stay put. You would line up outside the next morning and withdraw everything. The dollar works the same way. People all over the world hold dollars not because they love the US flag, but because they believe dollars are safer than their own local currencies. If you're in a country torn by war or inflation, holding dollars can mean the difference between keeping your life savings and watching them evaporate. And there's another layer. The dollar's strength is tied to US Treasuries. To buy those risk-free bonds, you first need dollars. So global demand for US bonds has always supported demand for US dollars. But if the US government ever openly defaults, and there's another layer, who would still want to hold dollars? Who would still treat them as the ultimate safe asset? The answer is obvious. Almost no one. The dollar would be dumped on an unprecedented scale, and US assets, from stocks to real estate, would crash in value. This is why the Fed cannot sit out, because behind the Fed are not just policymakers. Behind it are the capitalist elites whose fortunes are denominated in dollars and anchored in US assets. If the system collapses, their empires go down with it. Do you really think they will calmly watch their wealth evaporate? Of course not. So whether they admit it publicly or not, the Fed has no real choice. It must eventually reopen the money spigots and support US debt. In fact, there are already signs. The Fed has quietly stopped aggressively shrinking its balance sheet. The phase of pulling money out of the system is ending. The next phase is obvious, putting money back in. But how they do it, and at what interest rate, will decide who wins and who loses in this next chapter. Option 1. The Fed prints money and buys treasuries, but keeps interest rates high, around 4.5%. Many people hear 4.5% and shrug. It's not that high, they say. But remember, the US government used to borrow at or near 0%. Jumping to 4.5% is not a small change. It is a multiple. And they are not borrowing a few million. We are talking about trillions. A 1% increase on trillions of dollars is already a staggering amount. 4.5% turns debt service into a long-term chain around the government's neck. Where does that money ultimately come from? From taxpayers, from the real economy. In that scenario, the US government becomes a kind of permanent debt servant, working endlessly to pay interest to the holders of short-term treasuries, the very elites behind the Fed. The burden trickles down. Businesses pay more to borrow. Households pay more on mortgages, credit cards, and loans. Growth slows, layoffs rise, and weaker companies disappear. If the government must pay 4.5%, what interest rate do you think an ordinary company has to offer to attract financing? It's higher. Money won't survive it. Bankruptcies rise. Unemployment climbs. Consumers cut back. And when people stop spending, the economy contracts. Bankruptcies rise. Unemployment climbs. Consumers cut back. Stock markets fall. Bond markets shake. Exactly the kind of environment where the smart money, sitting patiently on the sidelines with cash and short-term bonds, starts to move. Take someone like Warren Buffett. In similar past cycles, he did not rush to chase asset bubbles. He hoarded cash. He bought short-term treasuries, 3-month, 6-month, 1-year bills, earning the high interest the government was forced to offer. So when the crash comes and markets are flooded with panic sellers, he is in the perfect position. He receives his principal and interest back from the government. He has dollars ready, while everyone else is desperate for liquidity. He steps in and buys premium assets at discount prices. In other words, he gets paid to wait and then gets paid again to buy. This is exactly the kind of dynamic that could play out again if high rates and crisis collide. Now, from the perspective of the US government, this high rate rescue is like trying to stabilize a collapsing building by putting heavier and heavier beams on top. The structure stays up a bit longer, but the load grows unbearable. That is why some political forces in the US don't just want the Fed to print money. They demand something much more radical. Cut rates. Cut them fast. Cut them hard. Because only by lowering interest costs can the government breathe, and only by violently shaking the markets can they force the Fed's hand. This is where the metaphor of the old, rotten house returns. You can either keep propping it up, letting the elites milk higher interest from a struggling state, or you can let it explode, taking stock markets, bonds, and even the dollar down with it, just long enough to justify printing at full speed and slashing rates to near zero. Which option will win? The slow strangulation of high rates, or the controlled burn of a global financial explosion? Behind the scenes, this isn't just an economic debate, it's a power struggle between a government drowning in debt and a financial elite determined to protect their wealth and control. The bomb that could decide this battle is already wired into the global system, and its name is trade war and tariffs, a tool that can trigger asset collapses far beyond Wall Street. How that bomb ties into the $6.5 trillion deadline and how it may be used to reorder wealth across the entire planet, that is what we would decode next. Every crisis in modern American history has a trigger, but the trigger is never random. It is chosen, timed, pulled with precision. In 2008, the trigger was subprime mortgages. In 2020, the trigger was a global pandemic. Today, the next trigger has a different shape, and it is far more deliberate. Tariffs and global trade tensions. People think tariffs are just taxes at the border. But in the language of geopolitics, tariffs are financial weapons. A tariff doesn't just hurt foreign exporters. A big enough tariff can set in motion a chain reaction. In 2008, the trigger was subprime mortgages. In 2020, the trigger was a global pandemic. Today, the next trigger has a different shape, and it is far more deliberate. Tariffs and global trade tensions. And in a world where nearly every country is overloaded with debt, even a small shock can turn into a landslide. So what happens when the US schedules a massive tariff escalation exactly 90 days after the $6.5 trillion debt deadline? It creates a perfect pressure cooker. The countdown looks like this. End of June, the US must roll over $6.5 trillion in old, cheap debt. July, tariff hikes resume, threatening to disrupt global trade and trigger asset collapses. It creates a perfect pressure cooker. Why would the US want markets to collapse? It creates a perfect pressure cooker. The countdown looks like this. When a global recession begins, countries with weaker currencies, weaker central banks, and weaker political systems break first. Their currencies fall. Their stock markets collapse. Investors flee into the dollar. That is the cycle that saved the dollar in 2008. That is the cycle that boosted the dollar in 2020. And this could be the cycle that repeats again in 2025. That is the cycle that saved the dollar in 2008. That is the cycle that boosted the dollar in 2020. And this could be the cycle that repeats again in 2025. Right now, the dollar index has already fallen around 10%. If it falls more before June, the US effectively pays back less in global purchasing power. The countdown looks like this. If $1,000 billion suddenly buys what $900 billion used to, then a 10% drop in the dollar is effectively a discount on debt. Right now, the dollar index has already fallen around 10%. If it falls more before June, the US effectively pays back less in global purchasing power. For a debtor drowning in obligations, a weaker currency is a gift. But there's a problem. When the dollar falls, other currencies rise. Right now, the dollar index has already fallen around 10%. If it falls more before June, the US effectively pays back less in global purchasing power. When the dollar falls, other currencies rise. Step 2. Tariffs the second blow. Once June passes and the US has rolled over its debt at higher interest rates, the next objective is to shake the system. How? By reactivating tariffs. Step 2. Tariffs the second blow. Traditionally, safe haven assets are US dollars, US Treasuries, gold. But with Treasuries currently unstable, the flow will first go gold, safe, rising, universal, and then later back into the dollar once markets crash deeply enough that the Fed is forced to intervene. This multi-step flow is intentional. By reactivating tariffs, first, weaken the dollar to reduce debt burden, then trigger a global shock to strengthen it back afterward. US dollars, US Treasuries, gold. And the most ironic part, America's advantage in gold. The US officially holds over 8,000 tons of gold. When you include gold held on behalf of foreign countries stored in the vaults of the Federal Reserve, the number rises to around 15,000 tons. That is more than the entire gold reserves of Russia, India, and all of Europe combined. Now consider this. If gold rises sharply, if every currency on earth weakens relative to gold, who benefits most? Now we can understand the old house metaphor clearly. By reactivating tariffs, detonate it in a controlled manner, and build a new one on the same land. Now we can understand the old house metaphor clearly. US dollars, US Treasuries, gold. Foundation cracked. Too much low-rate debt coming due. Walls unstable. Falling bond prices. Heavy scaffolding of leverage. Margin, repo, structured products. External pressure. China, Japan selling treasuries. The building is wobbling. There are only two strategies. Patch the building until it collapses, unexpectedly, or detonate it in a controlled manner and build a new one on the same land. Which strategy gives the US more control? The controlled demolition. In financial terms, that means trigger a market crash, scare the world, force the Fed to slash rates, force the Fed to print at maximum capacity, force global money to flow back into US assets, buy up the world at bargain prices. This is exactly what happened after the dot-com crash, after 2008, and after 2020. This is exactly what happened after the dot-com crash, after 2008, and after 2020. People forget something important. The US owns the global casino. When the casino burns down, the owner claims insurance, rebuilds bigger, and attracts everyone back. But the gamblers, the investors in weaker countries, lose everything in the fire. This is exactly what happened after the dot-com crash, after 2008, and after 2020. The controlled demolition. In 2008, the dollar fell before the crisis. After the collapse, the Fed printed and slashed rates. The dollar surged back as investors fled their own collapsing economies. The controlled demolition. It is engineered. During the crisis, the world collapses first. After the crisis, the dollar becomes the strongest asset on earth. And in the aftermath, US investors use their newly powerful dollars to buy global assets on discount. That country is the United States. So what does this mean for us? It means that the moves we see today, the falling dollar, the rising gold, the delayed tariff bomb, the debt deadline, are not random events. But the gamblers, the investors in weaker countries, lose everything in the fire. After the crisis, the dollar becomes the strongest asset on earth. So what does this mean for us? After the crisis, the dollar becomes the strongest asset on earth. And in the aftermath, US investors use their newly powerful dollars to buy global assets on discount. And in the aftermath, US investors use their newly powerful dollars to buy global assets on discount. After the crisis, the dollar becomes the strongest asset on earth. And in the aftermath, US investors use their newly powerful dollars to buy global assets on discount. When stocks fall, investors panic. When bonds fall, banks panic. When the dollar falls, governments panic. And in this triple fear environment, there is only one asset consistently rising: gold. And the entity that profits most when gold rises, and the entity that profits most when gold rises? The United States, the world's largest holder of gold reserves. This isn't coincidence. It's the first stage of the reset. The United States, the world's largest holder of gold reserves. You may have noticed something unusual this year. Gold making repeated new highs. The Japanese yen quietly strengthening. Defensive assets outperforming growth assets. Commodity-linked currencies stabilizing. Volatility slowly rising behind the scenes. You may have noticed something unusual this year. Gold making repeated new highs. The Japanese yen quietly strengthening. Defensive assets outperforming growth assets. Commodity-linked currencies stabilizing. Volatility slowly rising behind the scenes. But in reality, high rates are not a mistake, they are a weapon. They freeze the economy. They suffocate weak companies. They drain liquidity from overleveraged institutions. And they pressure the government by raising the cost of borrowing. High rates create the conditions for a controlled demolition. But once something breaks, the Fed must pivot aggressively. In 2008, the Fed held rates high for too long, then suddenly slashed them to nearly zero. But in reality, high rates create the conditions for a controlled demolition. So the moment the Fed cuts this year, whether in panic or under political pressure, will mark the beginning of the second half of the reset. In that phase, the winners are those holding cash, gold, yen, short-term treasuries, safe foreign currencies, defensive assets. In that phase, the winners are those holding Signal #4. Capital flees global markets. Cash, gold, yen, short-term treasuries, safe foreign currencies, defensive assets. But the gamblers, the investors in weaker countries lose everything in the fire. It works like this. Markets collapse. Investors panic. They liquidate everything. So what does this mean for us? They buy US assets at fire sale prices. It happened in 1997 during the Asian financial crisis. It happened in 2008 during the Great Recession. It happened in 2020 during the COVID crash. They buy US assets at fire sale prices. Imagine dozens of countries. They buy US assets at fire sale prices. While the US slowly positions itself as the safe harbor, ready to absorb global liquidity, the irony is brutal. The US triggers the storm, then becomes the shelter. As global assets drop 40%, 50%, even 70% in weaker economies, American corporations and funds will be sitting on mountains of strong dollars, ready to buy everything cheap: real estate, companies, minas, farmland, infrastructure, technology firms, energy assets. This is what people never understand. A crisis is not destruction. A crisis is redistribution. Wealth doesn't disappear. It changes hands. It happened in 1997 during the Asian financial crisis. It happened in 2008 during the Great Recession. It happened in 2020 during the COVID crash. When fear reaches its maximum, when gold becomes the only safe asset left, when newspapers scream about a new gold era, that is when the cycle will prepare to flip. Gold will not rise forever. High rates are not a mistake, they are a weapon. They freeze the economy. They suffocate weak companies. They drain liquidity from overleveraged institutions. And they pressure the government by raising the cost of borrowing. It works like this. Smart money will rotate out of gold and into US equities and US assets. High rates are not a mistake, they are a weapon. They freeze the economy. They suffocate weak companies. They drain liquidity from overleveraged institutions. And they pressure the government by raising the cost of borrowing. It works like this. US assets will enter the early stage of a new bull cycle. Gold will fall. The dollar will rise sharply. And global investors will chase the recovery. It is a playbook that repeats because it works. The winning strategy. The two halves game. The key to navigating what comes next is to view 2025-2026 as a two-phase game. Phase 1. Before the crisis. Hold refuge assets. USD, US equities, US tech, US REITs and real estate, corporate bonds. Select global assets at fire sale prices. This is where fortunes are made. Not by gambling, but by timing. Anyone who waits until the news declares crisis has already lost. Anyone who waits until the market headline says recovery has already missed the bottom. It is a playbook that repeats because it works. The winning strategy, the two halves game. To navigate it, we must map the path from here to the collapse and then to the recovery. This final chapter reveals the roadmap. Not predictions, but patterns. Not guesses, but signals drawn from history, math, and power dynamics. Because if you recognize these signals early, you won't panic when the world collapses. You'll understand. It is simply phase 1 of a larger plan, a plan that ends with one of the greatest buying moments of the decade. Everything revolves around these 3 months. Think of them as acts 1, 2, and 3 of a global drama. ACTI May to early June. The pre-crisis weakness. During this stage, markets behave strangely. The dollar weakens. Gold rises. Long-term bonds remain unstable. Short-term bonds attract smart money. Volatility creeps upward. Emerging markets start cracking. This is the silent preparation phase. But insiders know the truth. Before the rescue comes, there must be a collapse. But insiders know the truth. Before the rescue comes, there must be a collapse. This is where the panic begins. This is the pressure point. $6.5 trillion in cheap debt is expiring. The US must roll it over at high rates or default. If the world refuses to buy enough US Treasuries at these high rates, the financial system will seize. Shock global supply chains. Cut corporate earnings. Destabilize currencies. Accelerate recession pressure. Cause sell-offs across emerging markets. Magnify stock declines. Push investors into full defensive mode. This is where the panic begins. This is the spark. This is where the panic begins. Shock global supply chains. Cut corporate earnings. Destabilize currencies. Accelerate recession pressure. Cause sell-offs across emerging markets. Magnify stock declines. Push investors into full defensive mode. Shock global supply chains. Cut corporate earnings. Destabilize currencies. Accelerate recession pressure. Cause sell-offs across emerging markets. Magnify stock declines. Push investors into full defensive mode. And once global markets start to fall at the same time, a second force activates. Money flees weak markets. Money flees weak currencies. Money flees unstable governments. Where does it go? Now imagine combining. This is the beginning of the reset loop. The highest US interest rates in 15 years. The largest global debt load in history. Fragile, leveraged banks. Collapsing bond prices. Weakening US dollar. Rising gold. Upcoming tariffs. À 6,5 trillion debt rollover. Geopolitical tensions. Currency wars. Look at history. Now imagine combining the highest US interest rates in 15 years. The largest global debt load in history. Fragile, leveraged banks. Collapsing bond prices. Weakening US dollar. Rising gold. Upcoming tariffs. À 6,5 trillion debt rollover. Geopolitical tensions. Currency wars. This is the beginning of the reset loop. A 40-60% drop in global assets is not just possible. It is the pattern history shows whenever the system reaches these stress levels. Look at history. A crash is not the end. It is Act IV of the cycle. ACT4. The rescue and the rebirth. The moment markets fall deep enough, the Fed will be forced to act. They won't call it a bailout. They will call it the moment markets fall deep enough. But make no mistake, it is the same script. Cut interest rates, likely toward 0%, as in 2008 and 2020. Cut interest rates, likely toward 0%, as in 2008 and 2020. But make no mistake, it is the same script. And when that happens, the dollar will surge. Gold will peak and begin falling. US stocks will bottom and begin rising. Global currencies will collapse. Emerging markets will be crushed. Smart money will reposition into the US market. The dollar will surge. Gold will peak and begin falling. US stocks will bottom and begin rising. Global currencies will collapse. Emerging markets will be crushed. Smart money will reposition into the US market. They won't call it a bailout. They will call it, and when that happens, first, the dollar, then US stocks, then global assets at extreme discounts. We prepare. We don't predict exact dates. We read signals. We align our assets with the phase of the cycle. We stay calm while others panic. We build cash while others over-leverage. We accumulate gold while others doubt it. We watch the Fed like a hawk. We remain patient while the world screams contradictions. As the old system shakes, a new one will rise. Your task is simple. Be standing on the right side when the ground moves.